Here's a spread chart, but these numbers on the y-axis, they mean nothing. Here's a nearly identical chart, but these numbers are your actual return, minus 13 to plus 14%. Same shape, completely different meaning. Today, we build that difference. Last episode, we turned two stocks into a single line. The spread, oscillating around zero, always pulling back to the mean. It told us when to buy and when to sell, but it left two questions unanswered. Exactly how many shares of each do you trade, and what do you actually earn? Today we answer both, with two tools, Cointegration and the log spread. First, Cointegration. The word sounds heavy. The idea is simple. It's how much two stocks share the same trend and travel the same road. Think of it this way. Any stock price splits into two parts, a trend component riding the big move and a residual component wobbling on top. Two stocks tied to the same business, like Coca-Cola and Pepsi, share almost the same trend. So if you buy one and sell the other, when the market lifts both, what you gain on the long you lose on the short. The common trend cancels out. What's left? Only the small wobble between them, the residual. And that residual is the spread we actually trade. One thing to be clear about, Cointegration is not correlation. Correlation asks, do they move up and down together? Cointegration asks, is the gap between them stable? Two stocks can rise side by side, but if one creeps ahead, the gap keeps widening. High correlation, but not cointegrated. The real test for a pair isn't correlation, it's cointegration. So we buy one and sell the other. But in exactly what ratio does the common trend cancel? The number that tells you is the cointegration coefficient, written as ETA, and that ETA is your hedge ratio. Take the cleanest example, SPY and SSO. Both track the S&P 500, but SSO tracks it at 2 times the move. Say you buy $100 of SPY and sell $100 of SSO. When the market rises 1%, SPY makes $1, and SSO at 2% loses $2. Net minus $1. The market didn't cancel. Now sell only $50 of SSO. Market up 1%, SPY plus $1, SSO minus $1. Exactly zero. The market's direction is fully erased, and only the tiny difference between the two is left. That 0.5 is your hedge ratio, ETA. And that same ETA answers the question. For every 1 share of SPY you buy, you sell half a share of SSO. The how many shares that part 3 couldn't give you comes straight out of this one number. The more volatile stock you hold less of. You compute it as the covariance of the two log prices divided by the variance, the same idea as a beta in statistics. Now the second tool, the log spread. We just said subtract ETA times the other. Do that with log prices and you get this. The log price of A minus ETA times the log price of B. That's the log spread, a line that wobbles around an equilibrium by the residual. But here's the key. Why logs? Because a spread computed in logs equals a return. Remember part 3's normalized spread? The numbers on its y-axis meant nothing. They only showed wider, narrower. The log spread is the same shaped line, but its y-axis is an actual percentage return. If this line swings from minus 13% to plus 14%, then buying at the low and closing at the high would have captured about 27% in real money. That's the answer to the paradox from the opening. Two identically shaped charts. One is noise, one is your return. The difference was simply whether you took the log. Trading it works just like part 3, except now you know the size and the return. When the log spread spikes well above equilibrium, A is overvalued. You sell A and buy B. When it drops well below, you do the reverse. And when it returns to equilibrium, you close. Here's the difference. Now you know how much to trade, in the ETA ratio, and reading the spread number tells you the expected return in percent. The condition is the same as before. The line has to oscillate around equilibrium instead of drifting off. That is, the pair has to be cointegrated. Want to build it yourself? Like part 3, a spreadsheet is enough. Let's draw it with Home Depot and Lowe's. First, take the natural log of each stock's price. Then find ETA, the covariance of the two log prices, divided by the variance of the second. Then the log spread, the log of A minus ETA times the log of B. Finally, subtract the overall average to center the equilibrium at 0, and you have the residual. 3 ingredients: logs, a covariance ratio, and a subtraction. If the line oscillates inside a band, it's a good pair. If it drifts off in one direction, it isn't. Let me bring it together. Today you picked up 2 tools. Cointegration. You check whether 2 stocks share the same trend, and its hedge ratio, ETA, sets how many shares of each to trade. And the log spread. Its number is your expected return. The size and the return that part 3 left open are now filled in. The core toolkit for pairs trading is nearly complete. Next episode, we go practical. How to manage the risk and the actual order a real trade runs in. One last thing, and I mean it. Today was about how the log spread and cointegration work. It is not financial advice. The final call is always yours. If this helped, please like and subscribe. And in the comments, tell me, which 2 stocks would you compute a hedge ratio for first? I'll see you in the next one.